If you're looking for stock picks on CNBC or Reddit and wondering why you're not making any money, you need to watch this video. Let's assume you're the unluckiest person in the world. You dumped all your money in the stock market here in 2007, right before the market crashed, and then again you finally bought again in 2020, right before markets crashed again. Well, if you didn't sell, you're actually richer today than you were before. But what's ironic is 90% of people lose money in the stock market. And that's why in this video, I'm going to show you the number one thing that you can do to be a part of the 10% of people that are actually making money in the market. Most people think the stock market investing is going on to CNBC, Yahoo Finance, or Reddit, and then trying to find the next Nvidia or Tesla. But there's just one problem with that. By the time it's on the news, the real money has already been made. If you want to make money in the stock market, you need to start by understanding your strategy. Rule number one is you can either be a trader or an investor. An investor is somebody who wants to own a stock for at least a year, if not years or decades. A trader is somebody who wants to make a quick buck, and the reality is this trading is gambling, and that's not what we're going to talk about today, because if you really want to make some money, you're not going to do it by trading. You have to do it by being a long-term investor. Now, as an investor, there are three different sub-strategies that you can follow. You can be a passive investor, you can work with a financial advisor, or you can work to be an active investor. And let me show you why it's so important to do this, because this is what's going to make or break your portfolio. As a passive investor, your goal is just to own a piece of the market, and we have seen that the stock market has grown by an average of 10% a year. Now, this doesn't mean the markets go up. In fact, we know that recessions happen and we know that market crashes happen. Over the last 100 years, we have seen 16 recessions. Over the last 100 years, we've seen 25 stock market crashes, and by stock market crash, I mean a bear market when the stock market has fallen by 20% or more. So yes, the stock market falls, but despite these crashes, despite these recessions, the stock market has risen by around 10% a year. Now, there's a lot of different ways that you can invest in the stock market. One common way is the S&P 500. This is a group of the 500 largest companies in the stock market. And you don't have to go out and actually invest in each one of these 500 companies, because there are funds out there that will give you exposure to the S&P 500, and you really don't have to do any of the work. Now, I'm not telling you what to invest in. I don't recommend what I do to anybody else. Investing is risky, and you're never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. But a couple examples of ETFs, which are exchange traded funds that you can invest in on pretty much any brokerage out there that will give you exposure to the S&P 500, include SPY and VOO. As a disclaimer, I am personally invested in VOO. These are two different ETFs, meaning two different funds that if you bought one of these funds, you're getting exposure to the 500 largest companies in the stock market. Now, as of today, at the time we're recording this video, Amazon is one of those 500 largest companies, which means when you buy any one of these, you're buying Amazon, you're buying Apple, you're buying Nvidia. But the reason why I'm saying this is if Amazon were to have really bad products tomorrow, the CEO runs the company into the ground, and now they're on the verge of bankruptcy. Well, if you invested in the Amazon stock yourself, you would lose a lot of money, and now you have to think about what you want to do. With this, it's passive. And what that means is this fund will then kick Amazon out and replace it with another company, and you don't have to do anything. That's the advantage of investing into something like this, a fund, and it's passive, meaning you don't have to really do anything. You just have to keep investing in this fund. And we know that historically, the S&P 500 has averaged 10% a year. Does this mean the markets go up by 10% every single year? No, but after you factor in the booms and the recessions, it averages out to 10% a year. Now, when you do the math, that means if you invest $1,000 a month every year for the next 30 years with this 10% of return, you're going to have around $1.9 million at the end of those 30 years. Now, maybe that's a good number for you, maybe that's not a good number for you, but you can adjust these numbers by either investing more or working to get better returns. But the whole idea here, if you want to win, is you need to follow something like ABB. This is a phrase that I coined, stands for always be buying. If you want to win in the S&P 500, if you want to win as a passive investor, the way you win is by following ABB. And what that means is every week, every 2 weeks, or every month, you pick the cadence, you're just going to keep buying. And you're going to buy when markets are up and when markets are down. You're going to buy when there's a boom economy and it's a recession economy. You're going to buy when there's a Democrat in the White House and when there's a Republican in the White House. You're going to buy when it's raining. You're going to buy when it's snowing. You're going to buy when it's sunny. The reason why I emphasize this is because anytime we see a market pullback, the people that want to be passive investors say, oh my God, Jaspreet, the market is down. Should I sell? What do we do? And the only thing you want to change when markets are down is maybe you buy even more. Because recessions and market crashes create some of the best investment opportunities of ever, because they let you buy good investments at a discounted price for the financially savvy that are prepared. And this is where the way you win here is just let the markets do their thing and keep buying, and you do this for decades. And this has been a proven strategy to make people wealthy, because we know that over the long run, markets always go up. That doesn't mean they're going to go up in the short run. It doesn't mean they're going to go up in the next 6 months. It doesn't mean they're going to go up in the next couple of years. But over the long run, we know that markets always go up, and you can just own a piece of the markets if you want to see that upside. And this brings me to option number 2, investing with a financial advisor. Now again, for those of you that are investors, my team at Briefs Media publishes a free daily report called Market Briefs, where we break down what's happening in the economy, housing, stocks, crypto, and global markets into a fun, witty, and quick 5-minute read. We have hundreds of thousands of investors that wake up to and read Market Briefs every single morning. It's an amazing read, and I promise you're going to love it too. And if you don't love it, well, you can just unsubscribe at any time because it's free. And as an added bonus, when you join Market Briefs, you're also going to get my investing masterclass as a bonus just for joining. It's a complimentary free video that we're going to give you. So if you want to get Market Briefs for free, all you have to do is click the link down in the description below. So as a passive investor, all you're doing is you're investing in the markets, and you just want the markets to do the thing for the long term. With a financial advisor, now what you're going to do is you're going to pay a money manager to manage your money for you and invest it into the markets, and hopefully try to beat the markets. Can they guarantee that you're going to beat the markets? Well, maybe, maybe not, but you're paying them to hopefully beat the markets. And now let's run some numbers. You invest the same $1,000 a month with your financial advisor. You do this for the next 30 years, and your financial advisor is able to beat the markets. He's able to give you an 11% return, which looks great, but you got to remember your financial advisor is going to also charge you a fee. And many financial advisors are going to charge you something called AUM, assets under management. So let's assume now that your financial advisor charges you a small little 1.5% fee. That means over these 30 years, although you beat the markets, now you're going to be left with a little bit under $1.8 million, because the money that you paid in fees is going to now eat up some of your returns. Now, again, this is nice because it's hands-off. This is great for some people, but other people may not want to do that. They want to be a little bit more involved with their investments themselves, and you have to know what's right for you. If your financial advisor in this situation got a 13% return or 15% return, well, now you're going to be more profitable here than here, but that's where the risk comes into play. Your financial advisor could get you 11%, 15%, even 7%. And then you're going to have to pay the fee no matter what. So working with a financial advisor is not a bad thing. You just have to understand how they get paid, and you have to understand what they're investing in, because the problem and mistake that a lot of people make is they just assume that a financial advisor can read your mind, and then they assume that a financial advisor is going to give you the best returns, but you have to make sure that they're investing in a way that meets your goals. It's kind of like getting a second opinion if you were to get a bad diagnosis from the hospital or the doctor. You want to get a second and third opinion, and this is where your job is to be financially educated enough to speak to a financial advisor in a way to make sure that they're getting you the best return, so the fee that you're paying is actually putting more money in your pocket than if you went here and just passively invested your money into the markets. And then we have option number 3. And option number 3 is to be an active investor. This is what a lot of people try to do, is I want to invest in companies that I believe are going to become more valuable in the future. And the mistake that a lot of people make here is they want to be active investors, but then as soon as things go wrong, they then become day traders, because you hear about this cool stock on CNBC or Reddit, and then you buy into it, and then it goes down 4 or 5 or 7%, and now you think that the world's going to end because now the news has all this negative data, and now you want to sell. And this is where, if you want to be an active investor, which is great, you have to understand how to do it profitably. Now, the disclaimer that I want to give here is my personal opinion, is that for many, many, many people, this is probably one of the best ways to go. For other people, this is one of the best ways to go. And for some people, this is going to be the best ways to go, because this is going to be more risk for more potential return. It's going to take more work, more time. And so it's not for everybody. But the way you succeed, in my opinion, at least at our firm as well, the way you succeed as an active investor, because we have a number of analysts that publish research reports for active investors, it's called Briefs Pro. But what we do here with active investing is we like to study what's called a market shift. We want to know where the money is moving, that way you can invest based off of data, not the headlines, because if you can find the data where the money is moving, and then you find it as an investment opportunity before everybody starts dumping the money in there, Now you're investing not based off of the news, you're investing based off of data. That way, hopefully you can get in before the headlines. Of course, more risk for more potential returns. But you can start to see the value here, because if you can beat the markets by a little bit, well, that little bit of gains can add up to a lot more dollars. Because now if you invest the same, let's call it $1,000 a month, you do this for 30 years, and now we're not talking about 200% returns, 500% returns, 30% returns. Let's just say you can get a little bit better. 13% a year. Notice how on the internet, a lot of people talk about, oh, we got a 5,000% return here. Well, the reality is those things are not sustainable. But if you can get a slight edge on the market, you just get a few percent better a year compounded. Well, now instead of having $1.9 million or $1.8 million, now you're going to have, in this instance, more than $3.5 million, which means, yes, you made more than $1.5 million more just because you got a few extra points. But again, more risk for more potential return. There's no guarantee here. And this is where, if you want to be an active investor, amazing, understand that it comes with more risk, because there's a chance that you're not going to get 13%. There's a chance that you might get 2%, negative 1%, 9%, 15%. And that's where now the more research that you do, the better types of returns that you're going to get. But the goal is you need to have that investing mindset, because a lot of people now, when they get into investing, is they assume that, well, as soon as I buy the stock, it should go straight up forever. And now you start checking that stock after lunch, you start checking it before you leave the office, you start checking it as soon as you wake up, you start checking it throughout the day, and all you're doing is monitoring the stock price. And I want you to remember, if your goal is to be an investor, you have to start thinking like an investor. If you bought a house tomorrow, are you going to go onto Zillow 3 hours after closing to see what the valuation of the house is? Are you going to go onto it every single day to see if the valuation is going up and down? No. People are going to think you're crazy, because it's an investment, especially if it's a rental property. But we're doing that all the time with the stock market, because that's what the numbers show you. It's just going up and down all day and night long. But if you're an investor, remember, the goal is a long term. We're talking years. And so what's happening in the short term is just noise. And that's one of the things that becomes extremely difficult, because if you have a good investment that's backed by data, you did the research, you did the analysis, you want to own the company. And the stock price might not agree with the value of the company for a while. But if you believe in the value of that company, then you want to hold it for the long term. That way you can see the value of the company and the profits grow. That way you can get your share out of it, whether it's dividends, whether it's appreciation. But the whole idea here with the active investing is understanding, number one, it's more risk, but if you're going to be an active investor, you have to have a strategy as an active investor. The strategy here as a passive investor is ABB, always be buying. The strategy for us here in active investing is understanding market shifts, knowing where the money is moving. That way you can make an investment based off of data, based off of research, not based off of emotions, because by the time it's on CNBC, by the time it's on Reddit, a lot of that real money has already been made, and this is where now you need to pay attention to what's going on instead of just the headlines. That way you can find the opportunity that's better for you. And with that, I want to hear from you, because this will help me create better content for you in the future. What type of investor do you see yourself being? Do you see yourself being more of a passive investor, working with a financial advisor, or being more of an active investor? That way we can see what type of content we need to create more of. Let me know down in the comments. I can't wait to read it. And again, if you're an investor and you want to stay up to date on the markets, you can check out Market Briefs. I have that link for you down in the description. America is entering a death spiral.
When debts rise relative to incomes on a chronic basis, right now for the U.S. government, it's almost $1 trillion a year that goes to interest payments. When you run a large deficit, you have to sell debt to do that. And when I calculate it, the quantity of debt sold to be sold is much